Hey, I'm Tyler, and I'm your host. This is a good problem to have. I want to talk about student loan planning and tax filing decisions. Regardless of whether you're a med student or an attending, up and down, the relationship between student loans and tax filing are intimate. And if you've got federal student loans and you are trying to figure out how to manage cash flow as well as make the most of your public service loan forgiveness opportunity, PSLF, then this is for you. Tax filing, both the type of filing you do as well as the timing, are very relevant to maximizing the benefits of PSLF. And they also can help with mitigating the monthly payments. That latter strategy is more relevant to trainees because your income is limited and you're just trying to manage life, right? You're just trying to tread water. It is somewhat relevant to attending physicians too, just because you could be talking about the difference between an $1,800 monthly payment and a $3,000 monthly payment. Sometimes the decision matrix gives you those variable or variations of payments depending on the decisions that you make. So it's really important. And so I wanted to talk about this because of that. If you're married and you're trying to make a decision about filing jointly or separately, this is a complex decision. I'm going to talk about this first because what I'm going to tell you is you need to go hire a tax accountant that is student loan aware. Top of mind, Adam Markowitz. He and his team are awesome. I am not in any sort of business relationship with them. I just know they do great work. So just spoiler alert, I'm going to be telling you to go hire them because there are just so many variables in trying to decide which way is best, to file jointly or to file separately. Now, you could run the numbers yourself through like Free Tax USA or TurboTax and, run the return jointly, then back it out and then run the return filing separately and see what it spits out. Those types of software, they often make mistakes with filing separately, and especially is the case if you are in a community property state. Now, there are several of them. And if you're in a state that is a community property state, you absolutely need to hire a tax accountant to make this decision. I mean, unless you're going to file jointly just because you're going to, you're not, if you're not in this realm, I'm not saying every single person on this earth needs to hire a tax accountant, but if you've got student loans and you're in a community property state and you're trying to make some decisions, then you absolutely do need to hire somebody to help you to sift out the details, because boy, do they miss those. That software misses important details. I've seen it many times. So if you're married and you're trying to make that decision of filing jointly versus separately, basically the deal is you're trying to see if you can extract your spouse's income from the calculation. I guess I should share this caveat too. If you're married and your spouse doesn't earn an income, that creates an interesting situation if you're in a community property state. Because essentially when you file a tax return separately, it splits out the income. Like it takes the total and divides it by 2. So if you're in training and you made 80 and your spouse doesn't work, it's going to be like 40 and 40. Not exactly, but thereabouts. And, so there are some interesting ways to make the most of this decision. So as you can start to see under the hood, what I'm talking about. But it's very important to make sure that when you do decide to file your taxes separately in a community property state, that attribution of income is recorded and assigned correctly. So that's why I keep saying that. You got to hire somebody. Now, if you're single, you don't have to make this decision of filing jointly versus separately. It's just you, right? So you have a decision to make as far as timing. And this is the easier one. This is the easier area to address. And that is, are you going to file your tax return on time, or are you going to file an extension? And there's some things I want to talk about. There is no penalty for filing an extension. You don't pay more in taxes by filing an extension. The reason why this is the case is because when you file an extension correctly, and the online, the software, the do-it-yourself softwares can prepare you for this. I don't know how well they do it, but I know the accountants that I know, they do it really well. What they do is they gather your W-2 income and your mortgage interest statement and whatever else is necessary to be able to compile your return so that they can estimate if you owe anything. If you owe something, then you still have to make the payment by April 15th. But the tax return itself is not filed on April 15th. It's just that you make the payment if one is due, so that you do not owe interest on that payment that was due by April 15th. The IRS wants its money. They're okay waiting on the officiality of the tax return coming to its fruition. And you have, if this is a personal return, you have until October 15th to then file. This is a relevant strategy around student loan planning because you may have a big difference between your 2025 income and your 2024 income. And you may also be coming to a decision about your income-driven repayment plan option. I still know a lot of doctors that are on the SAVE plan. You got to get off of that. I mean, unless you're someone who's like gonna be like, well, I'm gonna pay this sucker off anyway, and I'm just trying to manage life in the last couple years of training. I'm thinking of some people that I know who are attendings. You got to get off of SAVE and you got to get on to IBR. The partial hardship requirement has been removed, by the way, on that. So you should be able to get onto IBR because those payments do count for PSLF. Whereas the SAVE months that are going by, they are not counting for PSLF, and you are counting on the PSLF buyback provision to be able to get those counted retroactively, which is a bit on shaky ground just because it's not something that is grounded in law and cannot be removed. And so if you're not able to get PSLF yet, you're hoping that that provision still hangs around long enough, right? That's what I'm saying. You got to get onto IBR. In any event, what I was saying about tax filing timing is that you may be making a decision about, well, am I going to go on this new WRAP plan that comes out this summer? I'm on IBR now, or I'm on SAVE, or whatever. If you file a tax return extension and your 2025 income was significantly higher than your 2024 income, and then come June, you're going to switch plans, or you may switch plans. This is the timeline of what's going to happen. Tax return extension filed, payment made by April 15th if one is due. Then sometime, say June, you make a decision to switch to a different repayment plan. When you do that, what tax return is the calculation being based on? The most recently filed tax return, which in this case would still be your 2024 tax return because you filed an extension for your 2025 tax return. And you have until October 15th to actually file it. So the payment amounts on your new income-driven repayment plan payment is based on 2024 income instead of 2025. These are a couple of examples of why student loan planning and tax filing decisions are very much related. So make sure that you give this attention. Make sure you give this a lot of attention so that you can make the most of the options that are in front of you. It is a stressful situation for sure. But if you lay out a plan, know what your options are, you'll be in as good a position as you can be. We'll talk next time.